When I traced where a lot of these posts were coming from about China dumping treasuries, it wasn't from some official announcement you and I can just click and read. It was coming from Treasury International Capital data, from box statements that got translated and filtered through financial media, and from analysts connecting dots between what China said at the BRICS summit and what they actually did with their reserves in the fourth quarter of 2020. 5. Here's what that means. China sold $400 billion in U.S. Treasuries, record amount. Same quarter, they added over 600 tons of gold to their official reserves. That's not a hedge. That's not diversification. That's a rotation. That's a deliberate move away from dollar-denominated assets and into hard assets that no central bank can print. And if you're not paying attention to what that signals about the dollar, about the treasury market, and about how the global monetary system is shifting in real time, you're going to miss the biggest macro story of the decade. I'm recording this right now from Chicago, and I want you to comment what day and date you're watching from, because I always love seeing how far these videos travel, and this is one of those stories where the timeline matters, because it's still unfolding. And real quick, if you value this kind of straight-shooting breakdown where we separate what's actually happening from what people are panicking about, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the claim making the rounds. China is de-dollarizing. They're dumping treasuries, buying gold, and preparing for a BRICS gold-backed currency that will challenge the dollar's reserve status. The dollar is collapsing. The treasury market is going to implode. We're heading into a monetary reset. And on the surface, it sounds airtight. Big numbers, geopolitical tension, a narrative that fits the current mood. But when you look at the numbers piece by piece, you realize some of it is solid, some of it is stretched, and some of it is just people taking a handful of true facts and turning it into a guaranteed collapse. That's clean. It's also incomplete. Because yes, China is rotating out of treasuries and into gold. But the question isn't whether that's happening. The question is why, how fast, and what it actually means for the dollar and for your portfolio. So I'm going to break down three things. First, what China actually did in Q4, what the data shows, and what the BOC has said publicly versus what they're doing quietly. Second, what de-dollarization actually means in practice, not in theory, and whether the dollar is collapsing or just losing market share slowly over decades. And third, what this means for you if you own treasuries, if you own gold, or if you're trying to figure out how to position in a world where the global reserve currency might be shifting. So let's start with what we can verify. China's treasury holdings dropped by $400 billion in the fourth quarter of 2025. That's reported through the U.S. Treasury's International Capital data system. It's public. It's verified. It's the largest single quarter reduction in years. At the same time, the People's Bank of China announced they added over 600 tons of gold to their official reserves. That's also public. That's also verified. Now, they don't announce every purchase in real time. They report in chunks. So when they say 600 tons, that could be accumulated over several months and reported all at once. But the direction is clear. Selling dollars, buying gold. That's not speculation. That's observable. Now, why are they doing this? The official reason, the one you'll hear from box statements, is portfolio diversification. They're reducing concentration risk. They don't want to be overexposed to any single currency or any single sovereign issuer. That's the diplomatic language. Here's the real reason, or at least the reason that fits the behavior. China is preparing for a world where the dollar is less dominant. They're watching the U.S. run massive deficits. They're watching the Fed print money, tighten, print again, zigzag on policy. They're watching U.S. politicians use the dollar as a weapon, freezing assets, imposing sanctions, threatening to cut countries off from the SWIFT payment system. And they're thinking, if the dollar can be weaponized against Russia, against Iran, against anyone the U.S. doesn't like, what's to stop it from being used against us? So they're reducing their exposure. Not overnight. Not in a way that crashes the Treasury market and hurts the value of the Treasuries they still hold, but steadily, deliberately, quietly. And here's the phrase that keeps showing up in BRICS summit statements, and I'm paraphrasing, but this is close. The need for alternative settlement mechanisms that reduce dependency on Western financial infrastructure. That's not a threat. That's a roadmap. They're saying we're building alternatives. We're building payment systems that bypass the dollar. We're building trade relationships that settle in local currencies or in commodities. And gold is the universal fallback. Gold is the asset that every central bank accepts. Gold is the thing you hold when you're not sure which currency is going to be the winner, so you hold the thing that's been money for 5,000 years. Here's a question for you. If you were running China's central bank, and you knew the U.S. could freeze your Treasury holdings with the stroke of a pen, would you keep adding to that position? Or would you diversify into something that can't be frozen? Drop that in the comments because I read them and I want to know how you're thinking about this. Now let's talk about de-dollarization, because this is where most people get it wrong. De-dollarization does not mean the dollar goes to zero. It does not mean the dollar collapses tomorrow. It means the dollar's share of global reserves, global trade, and global finance slowly declines over years or decades. Right now, the dollar is still around 60% of global reserves. It's still the dominant currency for oil, for commodities, for international trade. But 20 years ago, it was higher, and 10 years from now, it will likely be lower. That's de-dollarization. It's not a crash, it's erosion. It's a slow shift in market share. And the thing about slow shifts is they don't feel urgent until they hit a tipping point, and by the time you realize the tipping point happened, it's too late to position for it. China is not trying to crash the dollar. They still hold over $1 trillion in reserves even after the $400 billion reduction. If the dollar crashes, they lose. What they're trying to do is reduce their dependency so that when the dollar does weaken or when the U.S. does something they don't like, they have alternatives. They have gold. They have yuan. They have bilateral trade agreements that settle in local currencies. They have payment systems like SIPs that bypass SWIFT. They're building optionality, and the more optionality they build, the less leverage the U.S. has over them. Now here's where the BRICS gold-backed currency rumor comes in. At the most recent BRICS summit, there was talk, not an official announcement, but talk, about creating a new currency or settlement mechanism that would be backed by a basket of commodities, including gold. The details are vague, the timeline is unclear, but the intent is not. They want an alternative to the dollar that's not controlled by the U.S. Whether that actually happens, whether it works, whether it gains adoption, those are all open questions. But the fact that they're discussing it openly, the fact that they're aligning on the idea, that's a signal. It's a signal that the dollar's monopoly is being challenged, not by military force, not by sanctions, but by building parallel systems that work well enough that countries have a choice. Now here's the skeptical alternative. Could the dollar remain dominant for decades despite all of this? Yes, the dollar has network effects. Everyone uses it because everyone uses it. It's the language of global finance. Replacing it requires not just an alternative, but an alternative that's better, more liquid, more trusted. And right now, there's no currency that checks all those boxes. The yuan is not freely convertible. The euro has its own problems. Gold is not practical for everyday transactions. So even if China and the BRICS countries build alternatives, even if they reduce their dollar usage, the dollar can still remain the dominant reserve currency for a long time. That's plausible. Here's how it can fail. If the U.S. keeps running deficits that require printing money, if inflation stays elevated, if trust in U.S. institutions erodes, the network effects weaken. And at some point, the pain of staying in the dollar outweighs the convenience, and the shift accelerates. That's the risk. And I'm going to say something that might annoy both sides. The dollar is not collapsing. The dollar is also not going to stay at 60% of global reserves forever. Both of those things can be true. The world is moving toward a multipolar monetary system where the dollar is still important but not dominant, where gold plays a bigger role, where regional currencies matter more, and where no single country has the kind of monetary hegemony the U.S. has had for the last 70 years. That's not a crash. That's a transition. And transitions take time. But if you're not positioned for the transition, you'll get caught when it accelerates. Now, let's map two plausible paths without pretending we can predict the exact candle. Path 1, China continues to slowly rotate out of treasuries and into gold. Other central banks watching China start doing the same, not all at once, not in a coordinated way, but steadily. The Treasury market absorbs it because the Fed steps in as a buyer, because domestic buyers step in, because yields rise enough to attract new demand. The dollar weakens gradually. Gold grinds higher. It's not dramatic. It's not a crash. It's just a slow shift in the global financial architecture. That's within the set of things this system is capable of doing. Path 2. Something breaks. A country tries to sell a large amount of treasuries and there's no buyer. Yields spike. The Fed has to print to stabilize the market. That spooks other central banks. They accelerate their rotation out of dollars. The dollar weakens sharply. Gold rips higher, not because of fundamentals, because of fear, because of a loss of confidence. That's also plausible. I'm not predicting it. I'm saying it's a tail risk that's worth considering, especially if you're heavily exposed to dollar-denominated assets with no hedge. Here's what to watch. First, watch Treasury auctions. If you start seeing weak demand, if yields have to rise more than expected to clear the auction, that's a sign that foreign buyers are stepping back and the U.S. is having to pay more to borrow. Second, watch central bank gold purchases. If this trend accelerates, if more countries follow China's lead, that's confirmation that the de-dollarization trade is real and it's building momentum. Third, watch the dollar index. If the dollar starts weakening despite the Fed holding rates steady, that's a sign that structural factors, not just interest rate differentials, are driving the currency. And fourth, watch BRICS developments. If they actually launch a gold-backed currency or settlement mechanism, even if it's limited in scope, that's a proof of concept that could gain traction over time. Now here's the uncomfortable truth. If you're holding treasuries, especially long-duration treasuries, you're exposed to the risk that foreign central banks continue to sell and yields rise. Rising yields mean falling bond prices. That's not a crash call. That's a risk you need to understand. If you're holding cash in dollars, you're exposed to the risk that the dollar weakens over time and your purchasing power erodes, especially if you're buying things priced in other currencies or in hard assets. And if you're not holding any gold, you're exposed to the risk that the one asset that benefits from monetary instability and de-dollarization is the one you don't own. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Consider reducing your exposure to long-duration treasuries if you're heavily weighted there. Not because they're going to zero, because the risk-reward is skewed. If you're going to hold bonds, stay shorter duration where you have less interest rate risk. Step 2. If you don't own gold, consider adding some. Not as a speculation, as a hedge. 5, 10, 15% of your portfolio depending on your risk tolerance. If the dollar stays strong, you have a hedge that didn't hurt you. If the dollar weakens, you have a hedge that protects you. Step 3. Don't panic. China selling $400 billion in treasuries is significant, but the treasury market is massive. It can absorb this. The risk is not the single event. The risk is the trend. So position for the trend, not the headline. Step 4. Diversify your currency exposure if you can. Don't have everything in dollars. Consider holding some assets in other currencies, in commodities, in businesses that generate revenue globally. That way, if the dollar weakens, you're not entirely exposed. Now, here are my questions for you. Do you think China is preparing for a world where the dollar is less dominant? Or do you think this is just normal portfolio management? And if you had to choose, would you rather hold treasuries or gold right now? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when we get more data on central bank positioning and BRICS developments. And if this helped you, share it with someone who's trying to figure out what China's moves mean for their portfolio. All right, keep your head clear, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.